The world of finance is undergoing a radical transformation. For centuries, governments and banks controlled money, dictating its value, distribution, and who could access it. But with the rise of cryptocurrency, that monopoly is being shattered. Crypto has introduced a new paradigm of financial freedom, allowing individuals to own, trade, and transfer value without centralized control. However, not all cryptocurrencies are created equal. Some projects skyrocket in value, building billion-dollar ecosystems, while others fade into obscurity. The key factor that separates thriving crypto projects from failed experiments is tokenomics, the economic design behind digital assets. Tokenomics is the hidden blueprint that dictates how a cryptocurrency functions, grows, and sustains itself. It determines the supply, demand, incentives, and long-term viability of a token. Understanding tokenomics is not just for developers or economists, it is essential for anyone looking to invest in crypto, build blockchain projects, or simply navigate the Web3 space. This video will break down the fundamentals of tokenomics, exploring what makes a project valuable, sustainable, and worth paying attention to. By the end, you will be equipped with a powerful framework to evaluate crypto projects, identify scams, and position yourself for success in the digital economy. The principles of tokenomics affect everyone in the crypto space, whether you're an investor, developer, or entrepreneur. Learning to read a project's tokenomics model is the difference between making informed decisions and getting caught in hype-driven speculation. Before you buy any cryptocurrency, you should ask yourself, does this token have real utility? How is its supply controlled? Are incentives aligned for long-term growth? To begin your journey into the science of digital value, start by reviewing the white papers of projects you're interested in. The tokenomics section will reveal how the cryptocurrency is structured and whether it has a solid foundation. Tokenomics is the economic model of a cryptocurrency, defining the rules that govern its creation, distribution, and value. Every cryptocurrency follows a set of principles that determine how tokens are introduced, what drives their demand, and how they sustain long-term viability. Without strong tokenomics, a crypto project is destined to fail, no matter how good the underlying technology is. A well-designed tokenomics model ensures that a project remains economically sustainable. It provides incentives that encourage users to hold, stake, and use the token, rather than simply dumping it for short-term profits. Strong tokenomics prevents inflation, discourages manipulation by early investors, and ensures that a project's ecosystem continues to grow over time. When evaluating a crypto project, one of the first things you should examine is its tokenomics structure. You should look at how the token is being used within the ecosystem, whether it has real-world utility, and whether its supply and demand mechanics create long-term sustainability. If a project has poorly designed tokenomics, it can lead to massive sell-offs, unstable markets, and eventual collapse. The first step to mastering tokenomics is understanding the different factors that determine a token's value, starting with supply and scarcity. One of the most fundamental principles of economics is supply and demand. In the traditional financial world, central banks control the supply of money, adjusting interest rates and issuing new currency to manage inflation. In crypto, supply is programmed into the blockchain, creating a fixed set of rules that determine how tokens enter circulation. Bitcoin is the perfect example of scarcity-driven value. With a fixed supply of 21 million coins, Bitcoin is programmed to be rare, making it digital gold in the crypto world. Unlike fiat currencies, which can be printed endlessly, Bitcoin's supply is hard-coded into its protocol. This built-in scarcity has driven mass adoption and increased demand, causing its value to rise over time. Other cryptocurrencies use different supply models. Some, like Ethereum, originally had an inflationary supply, where new tokens were constantly being created. However, Ethereum later introduced a burn mechanism, which permanently removes a portion of the supply, making it more scarce over time. Tokens that have unlimited supply with no burning mechanism often struggle to maintain long-term value. If a project continuously creates more tokens without demand to match, it leads to inflation and price collapse. This is why it's essential to analyze a project's supply structure before investing. To avoid inflation risks, always check the maximum supply and issuance schedule of a token. If a project has a high supply cap and no deflationary measures, its value may decrease over time. A cryptocurrency's value is not just determined by supply, it must have real utility to drive demand. A token must serve a purpose within its ecosystem, whether it's being used for transactions, governance, staking, or access to services. Without utility, a token is nothing more than a speculative asset waiting for a crash. Bitcoin's utility comes from being a decentralized store of value and medium of exchange. Ethereum's utility comes from its smart contracts, which allow developers to build decentralized applications or dApps on top of its blockchain. Tokens like Chainlink or Link are valuable because they enable secure data transfer between blockchains and real-world applications. Utility can take different forms, including payment tokens like Bitcoin and Litecoin, used for transactions. Staking tokens like Ethereum and Solana, where holders earn rewards for securing the network. Governance tokens like Uniswap and Aave, giving holders voting power over protocol decisions. And access tokens like Theta and Chiliz, providing special privileges within platforms. The more essential a token is to its ecosystem, the stronger its demand. When evaluating a project, always ask, do people need this token or is it just hype? A crypto project may have strong fundamentals, but if a small group of insiders control most of the supply, it poses a serious risk. Token distribution is one of the biggest indicators of long-term sustainability. If a project is heavily concentrated in the hands of founders, early investors, or whales, they can manipulate the market by dumping large amounts of tokens at once, causing a price crash. Fair token distribution is essential to ensuring that no single entity has too much control over the project. A fair launch, like Bitcoin's mining-based distribution, is ideal because it ensures decentralization. On the other hand, pre-mined tokens can create unfair advantages for early adopters. Before investing in a project, check the token allocation chart to see how much of the supply is held by the development team, private investors, and the community. If the majority of tokens are locked in vesting schedules, this is a sign of a well-structured project because it prevents early investors from selling everything at once. However, if insiders control a large percentage of the circulating supply, it's a major red flag. To analyze token distribution, use blockchain explorers like Etherscan or BSCScan to check the top wallet holders. If a few wallets hold a massive portion of the supply, be cautious before investing. Understanding tokenomics is one of the most powerful skills you can develop in the crypto space. It allows you to separate hype from reality, avoid scams, and invest in projects with strong fundamentals.